There's £26 billion in lost workplace pensions. This is heartbreaking as this is people's money and they have no idea they're missing it. But before coming on to that, as well as exactly what you need to do with your workplace pension, whether you should consolidate into a SIPP and more, let's go back 14 years. This is going to be a longer video, so grab a cup of tea and stick it on 1.5 times speed if you need to. But if you've ever had a job in the UK, this video could genuinely be worth tens of thousands of pounds to you. The changes we're going to go through have already put thousands of pounds back into my pocket. But 2012, this was the London Olympics, the release of the greatest ever song. I was playing FIFA Ultimate Team instead of buying Bitcoin for $10, and there was meant to be a black hole that would destroy the world. But most importantly, there was a change in UK pension law. I bet that's really excited you. But 2012 saw the year of pension auto-enrolment. This initially requested large employers of more than 250 staff to automatically enroll their staff who are over 22 years of age into workplace pensions. This helped millions save for retirement even if they didn't realize it. This was phased in over time, as you can see here. And this bit highlighted shows where we're at today. If you're age 22 to state pension age and earn over £10,000 per year, you must be auto-enrolled by law. Contributions into workplace pensions are calculated on something called qualifying earnings, which based on current thresholds is part of your salary between these two limits. The minimum total contribution is 8%, 3% from your employer and 5% from you. And this applies only to that qualifying amount. For example, on a £35,000 salary, your qualifying earnings are just under £29,000. 8% of that is roughly £2,500 per year, split between your contribution and your employer's contribution. This means roughly 6.6% of your gross salary is going into your workplace pension before tax relief. The real cost to you, in this example as a basic rate taxpayer, isn't the £1,438, but the £1,150 due to tax relief. So put another way, you've avoided some tax, and that is the power of pensions. Two important points to make. Firstly, many employers give more than 3%. And secondly, some employers will match on total gross salary, not just on qualifying earnings, like in this example. There are around 10 million active auto-enrolled pensions with hundreds of billions of pounds in. You can opt out, but opt-out rates are actually quite low. So this is clearly working. This change in 2012 that was then phased in might be the best change in history for us Brits long-term saving and investing. For transparency, I myself used to get a 6% employer match. So I had 12% of my gross salary going into my workplace pension each month, half of which was free money from my employer, helping to boost my investment pot. Now, some people will argue this isn't really free money, it's just part of your overall compensation package, which I do get, but I personally always saw it as a bonus. So I call it free money. Whether or not that's right, you can be the judge. So why does all of this matter? Ultimately, workplace pensions are many people's largest and most important investment accounts. However, they're massively neglected. Many people, myself included many years ago, bury their head in the sand, out of sight, out of mind. But this might mean you leave thousands of pounds, even hundreds of thousands of pounds if you're a high earner, on the table over the long term. On an average UK salary that goes up with inflation, you'd end up with around £1 million across your working life in a workplace pension, assuming an 8% rate of return. That is the power of auto-enrolment, the free employer match, and long-term compounding. There are caveats, there are assumptions, of course. This is just a simple, relatively static compounding calculation. But for argument's sake, if you're able to eke out an extra 1% per year from your workplace pension, reducing your fees, switching from the default fund to a different fund, as you can see, this can put even more money, hundreds of thousands of pounds, back into your pocket. I wasn't exaggerating, and that's why this topic and this video matters and why I'm passionate about this. Anyway, that's the background. Let's get into the practical side of all of this. What do you actually need to do? What do you need to consider? What actions might you need to take? And if you don't know how much is in your workplace pension, this video is definitely for you. If you're new here, hi, I'm Ryan. I'm a chartered accountant and I built my own investment portfolio, including my workplace pension, to 6 figures over the last 8 years. And now I help others do the same to invest simply to build their wealth. Before we get into the meat of it, quickly, why are pensions so good? You probably already know this, and there is some nuance with the different schemes, But in short, it's because of the tax relief. Pension contributions get topped up, making them a very tax advantageous way for us to invest for our retirement. The more you earn, the more advantageous a pension becomes because of how the tax relief works. Pension contributions can be used to pull you into lower tax brackets, and you could get tax relief at say 40% today as a high rate taxpayer, but then only pay income tax of 20% in the future when you draw down on the money. The main downside is accessibility and inflexibility. You generally can't access them until your mid to late 20s, and that age is only going to increase. Why are workplace pensions specifically so good then? Number one, because of the employer match. This is free money, well, in my opinion anyway. Whatever percentage your employer matches, try to take full advantage of. Two, because the money's locked up, so we're less likely to mess around with them and instead let them compound for decades. Three, because of auto-enrolment, so all of this will be happening automatically for you. Okay, let's talk about your current workplace pension, then we'll come on to switching funds, switching platforms, and old workplace pensions you might want to consolidate. So your current workplace pension, what do you need to do? There are 5 steps to take. First, get access to your workplace pension as soon as possible. When you started working, you should have got some paperwork, but contact your workplace HR if you're unsure who your workplace pension provider is. Tip, once you do have access, sign up with your personal email and not your work email. You'll probably leave that job at some point. Second, once you have the login details, you guessed it, log in. Honestly, I'm becoming more and more like Einstein each day on this channel. Log in and see how much you have. The important point here is that this isn't imaginary. This is your money and it's being invested into something. One day you're going to access this money and live off of it. Many, myself included at the start, think this is imaginary money. It's not. It's real, it's your money, and it's being invested into the markets. Third, make sure the right amount is going in each month. Check your payslip, check your pension account, whether that's on the website or on the app, and make sure it's correct and it matches up. This is particularly important if you're working for a small firm. They probably won't mess it up, but just make sure the right amount is going in. Fourth, what is your money actually being invested into? You will likely see one specific fund on the homepage or under investments when you do log in. This is likely or almost certainly one of the default funds that you would have been auto-enrolled into. You should see the cost basis, which is how much you and your employer have actually put into the fund, and the equity or value, how much that investment is worth. And hopefully you're in the green and the investment has gone up a lot, particularly if you've been working for many years. We're going to come on to this default fund and switching funds in a second, but for now, just make a note of where your money is actually going into. Fifth, fees. Find out exactly what fees you're paying. This can be a bit of a minefield and difficult to work out. I found this from personal experience with old workplace pensions, but you will almost certainly be paying a platform fee to the pension provider and a fund fee based on a specific fund you're using. If in doubt, contact the workplace pension provider directly. I've done this myself in the past to find out exactly what fees I'm paying in my workplace pension. You can usually either give them a call or just message them on the in-website or in-app chat. And as a tip here, try to keep your fees lower than 0.5% across your total workplace pension. Some employers, particularly large employers, can actually sometimes negotiate a discount on fees. So you might be paying lower fees than is available to the general public based on the deal your employer's made with the workplace pension provider. Those are the 5 steps that you need to take if you haven't already. Just to reiterate one more time, this is your money in that workplace pension, so take control of it. If all of this is sounding overwhelming, if you do need a hand with your own workplace pension, if you're looking to build a long-term investing plan and looking for something that's tailored to you, some tailored one-on-one support, I would honestly love to help you out. Click the first link below in the description and I'll tell you exactly how I can help you. Genuinely, a few tweaks, as we're gonna go through in this video, could put so much money back in your pocket over the long term. That link in the description is kicking off though in less than 1 week on the 19th of January. So be quick, and I'm absolutely buzzing for it to start. Before we come on to the actual fund in your workplace pension, a quick side point. If you have a DB pension, a defined benefit pension, for example, you work in NHS, you're a teacher, in most cases with DB pensions, you don't need active management. You don't need to really do anything. Saying that, you should of course still understand the scheme and keep track of them. But generally speaking, those 5 steps we just ran through and switching funds, what we're gonna come on to, won't apply to you. The state pension, which who knows if that'll be around in 30 years time, we'll see, is also different to this. And that's based on how many years of qualifying NI contributions you have. It's a bit of jargon, but what we're going to be going through is defined contribution pensions, which are in this day and age, normally your sort of standard 9 to 5 workplace pensions and SIPPs. Okay. Let's talk about the fund your workplace pension is invested in. Ultimately, the return of your workplace pension depends on what you're invested into. You will most likely be in the default fund. We are almost certainly auto-enrolled into this, although the specific default fund depends on the workplace pension provider. It's usually some type of multi-asset fund. If you're younger, it should include more stocks, but it might still also include some cash, bonds, commodities, metals, property. It usually then de-risks over time, moving you to safer assets like bond and cash and away from stocks as you approach retirement. The issue I found both personally and through speaking to others over the years is that this default fund could leave you with massively subpar investing returns after 40 years of investing. Supposedly 97% of people stick to this default fund. I think that's all too often because people don't realize they can actually get access to this and change where their money's being invested. But before you decide whether you should switch funds, let me tell you a personal story from my own workplace pension experiences. One's good and one's bad. Then I'll tell you exactly what to consider when it comes to switching funds. I got auto-enrolled into a workplace pension in 2017 when I did an industrial placement year during uni. This was with Standard Life and I got auto-enrolled into the multi-asset default fund. Between 2017 and 2022, I made 6.54%. Meanwhile, the global stock market was up over 50% during that same time period. In fairness, my salary wasn't very much during that placement year, so there wasn't very much in the workplace pension by the time I eventually moved that old workplace pension into my SIPP. More on that in a second. The absolute amount wasn't a lot, but it was my own fault for taking so long, so many years to take ownership of that money. And I ultimately paid for it because I missed out on massive gains over that period. Now for the good story that put thousands of pounds into my pocket. When I properly started working as an accountant after uni in 2019, I once again got auto-enrolled into a pension, this time with legal and general. Luckily this time I was more financially literate and I took control of this workplace pension straight away, using the exact same 5 steps that we went through before. I got access and logged in soon after starting work. My money once again was being auto-enrolled into a high fee multi-asset fund. The fee for this specific fund alone was 0.78%. The fund was a multi-asset default fund as expected. It had some money allocated to bonds, some to cash. It is worth saying I was working in accounting at the time and I had clients, so due to independence rules, I didn't have that many fund options available. From memory, there was about 10 to 15 different funds we could invest into, but I swiftly switched to a fund that suited my risk tolerance, time horizon, and goals much better, and this was a global equity tracker fund. It was a 100% stock fund, which was globally diversified for a much lower fee of 0.2%. I ended up consolidating this second workplace pension into my SIPP as well, and I did this in early 2025. But before I did, I checked the performance. Amazingly, the returns of this default fund over the previous 5 years was 11% in total. The fund that I switched to was 78% up. I actually made a full Instagram reel about this at the time, and it only took a little bit of looking into, choosing a fund that matched my preferences better, and the click of a few buttons. One thing I see people do wrong, and I mean, I did it wrong myself in that first story, is just ignoring this for years, sometimes for decades. Please don't do that. Please don't do that. It is aggro, it is admin, it's a pain, but it is genuinely worth looking into. Not to say this always happens, of course. Investment returns are unpredictable. Past performance is not a measure of future returns. Maybe I just got lucky with the fund I switched from and to and got lucky with the timing, but I knew the approach I wanted to take. I wanted to take a more aggressive approach based on my preferences. So I found the lowest fee, most global stock fund I could find on the platform, took action, switched to it, and that's literally put thousands of pounds into my pocket over the years. Why did this happen? I think the main reason is that these default funds are usually quite cautious and risk averse, which it does make sense. Investing does make a lot of people nervous, particularly us Brits. We don't necessarily like taking risks or like talking about money. However, the fact you're watching this video, that's probably not you. And hopefully I'm not sounding like a broken record here, but a workplace pension is your money. It is being invested and you will use this money to fund your lifestyle one day. And that is why we need to take control of it. Everyone's situation is different. Investing is personal, but if you have a long time horizon with decades and decades of investing ahead of you, you likely can take a more aggressive approach. And switching funds to something that matches your personal profile a bit more could potentially boost your pension pot over the decades. That's what I personally did, and I think it's something worth considering. I was able to cut my fees by 75% and increase my returns by 7x by switching funds, and that's only in a relatively short period of time. Picking a fund to switch to is difficult for two main reasons though. Number one, different providers have different options. Some providers have a very limited selection of funds. But secondly, on the other hand, some providers have thousands of options, which can make it very overwhelming. For me, I knew I wanted a global approach, so I went to the options available in the workplace pension. I searched for buzzwords like world and global, and this helped me narrow down the list. And then once again, as I said, pick the lowest fee, most global 100% stock fund. You might not want to do that. You might want to invest into something different, and that's absolutely no problem. But that is how you can start to narrow down the search for the best option for your situation. The main downside with switching funds is that you might feel nervous making a decision. It can be quite overwhelming and confusing to try and pick the right fund for you. If you have any questions, please feel free to leave them in the comments below. I'd be happy to help. And if you yourself have switched pension funds or looked into this in the past, please leave your help and guidance as well in the comments below. And if you do need a helping hand and some more specific help on this, click the first link in the description and that's how I can help you. I told you this would be a longer video. Hopefully you've got it on 1.5 times speed. But now let's come on to switching platforms. Firstly, why would you want to switch platforms? Ultimately for three main reasons. To get a better range of investment options, to pay lower fees, to use a platform that you prefer more. This one is a bit more straightforward. It's actually normally not a good idea to switch away from your current workplace pension, and that's because you might accidentally shut down the workplace pension. You don't want to do this. You want to keep the workplace pension open so your contributions and the employer match keep going in each month. You could check if your pension provider allows partial transfers. Some schemes allow partial transfers of money out. If this is you, assuming your workplace pension is poor, you could periodically partially move the money out from your current workplace pension to a SIPP, and that SIPP could have better investment options and lower fees. However, many don't offer partial transfers, so you'll need to check. And if that is the case where you can't do this, then unfortunately, you might just be stuck with the current provider whilst you work at your current job. And that's ultimately why switching funds inside the pension, what we went through, could be a good option instead. That's switching your current workplace pension. Let's now talk about switching your old workplace pensions. These are the ones that you're no longer contributing to and using because you've moved employers. When it comes to switching platforms for old pensions, there's a bit more to think about. You could consolidate old workplace pension pots either into a SIPP or into your current workplace pension if your current workplace pension is good. I personally did the former and I consolidated my old pots into a SIPP. This gave me access to a better global fund and to lower fees. Why would you want to consolidate old pots? Of course, as we've already said, better investment options and lower fees, but also, importantly, because of admin. If you have 5 old workplace pensions with different providers, I'd personally say it's easier to manage them all in one big pot on one platform that you like than trying to manage all these different pots. It also means you're much less likely to lose your pension pots and forget about them. If your situation is quite messy or complex or you're dealing with large amounts, it could be worth speaking to a financial advisor. Now, before you go consolidating all of your pots into a SIPP, make sure you're not losing any perks, guarantees, or benefits from the old workplace pensions. Particularly if there's older pots you've got from the 90s or noughties, you might have some extra benefits attached to them. For example, an earlier access age or a larger tax-free lump sum. If you move that money, you'll then lose those benefits. So call up the pension provider before moving anything just to make sure you're not losing out. Assuming you still want to consolidate into a low-cost SIPP, you can then pick a SIPP on a platform of your choice. Vanguard, InvestEngine, AJ Bell, Hargreaves Lansdown, there's many SIPP providers. Secondly, let's talk about finding old workplace pension pots. You might have money that is yours that you didn't even realize, and there's billions in lost pensions. If you think you might have lost a pension, the government has a pension tracing service. You do need a few details, but this could be a very lucrative bit of time well spent. You might spend an hour and find thousands of pounds in a workplace pension. And for anyone watching who's at the start of their career, just make sure you always keep track of your old workplace pensions so you're then not adding to this lost workplace pension statistic. Okay, we've covered a lot. So what makes a good workplace pension? I would say it's quite simple. It is a pot of money that you have access to as you have the login details, has the right amount going in each month, where you're paying low fees, ideally less than 0.5% in total, with a good selection of investment options, or at least a fund that you like where you can invest your money. What is the best approach for most people? I would say, and this is what I did myself for many years, to have your current workplace pension, which you keep open to get your contribution and your employer's contribution going into each month. Potentially though, consider switching funds to one that better suits you, as well as a SIPP to then consolidate old pots into as you move jobs. As I've said many times, and I'm sorry to beat a dead horse here, this will likely give you more options, lower fees, and most importantly, it means you won't lose any of your pension pots. And of course, you can make further contributions to get extra tax relief if you'd like. Let's summarize. The starting point is to get access and take ownership of your workplace pension. That is the main message of this very long video. And that's for both your current workplace pension and any old workplace pensions. Then consider switching funds, switching platforms, consolidating old pots. You might not need to do any of this, but it's worth considering and thinking about. Last thing I wanted to touch on here, I think we've covered pretty much everything, is how could the government actually improve this workplace pension system even further, because it really has been a game changer since it came in 2012. Some ideas: lowering the auto-enrolment age to 18 rather than 22, increasing that minimum employer contribution over time from 3%, better education on how to access pensions, how to consolidate pensions. Saying it out loud now, that's probably, I'd say, the most important one, because so many people just forget about this. And the thing with workplace pensions is, because the money is going to be invested for decades, you probably will wake up in 30, 40 years time and have multiple six figures. And that's great. But by making a few little tweaks based on your personal preferences and situation, you might be able to put more and more multiple six figures back into your pocket. And that's why all of this is so important. But overall, the workplace pension system in the UK is great. It's a good system and it's done loads of good for millions of people. Just make sure you're taking ownership of all of this, because it is ultimately your money and it's being invested. Thought I'd just say that one more time here at the end. If you need some ideas of what to actually invest into inside your portfolio, maybe if you're going to open up a SIPP off of the back of this video, then check out this video here next, where I roasted some of my subscriber portfolios and gave them some tips on how they could potentially improve their investment portfolios. Thanks for watching. Hope it was helpful. This has been a long video. I really appreciate you've got to the end. Subscribe for more, and I'll see you in the next one. Didn't even really make a dent in my cup of tea, to be honest with you, if you can see that there.